Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. As you all know, markets have continued to be volatile this year, and today we wanted to take this opportunity to talk about the different risk factors that are contributing to the volatility and how at Westwood we manage around risk. For that, we have Kelly Stark and Ben Chittenden joining us on the call as well. Kelly is our head of risk and performance analytics, and Ben is a vice president and a portfolio manager on our multi asset team. Hi, Kelly and Ben, how are you doing?
Hi,
Hello. Good.
Maria.
I'm so excited to have this conversation with you guys, and I know that risk is something that is on top of our clients' minds as well. So let's get started. Ben, my first question is for you. As I said earlier, markets have been shaken this year by a lot of uncertainty, especially around global growth and inflation. Can you help us think through these concerns?
Sure. Yeah, absolutely. Let me start with inflation because I think that's probably the best place to start. It's on everybody's mind. And let me just take a step back to say why it matters so much. Obviously, as individual consumers, we know how inflation impacts us, right? The higher prices go, eventually it hits the point where you say, okay, not going to even buy it because it's too expensive. And so that is demand destruction. What does it mean for the market, though? It really has to do with how much you're willing to pay for a dollar of earnings, right? And so when inflation goes up, you generally want to pay less for that dollar of earnings or future earnings. And when inflation comes down, the market historically has been more willing to pay more for a dollar of earnings. And so obviously it's a key question because that's one of the key pieces in terms of thinking about the aggregate market. How much earnings are you going to have? And then what do you want to pay for that dollar of earnings? I would say that, given inflation's at 40-year highs, it's something clearly we're paying a lot of attention to. One of the key ways that we look at it is not so much the level, but the breadth of categories that are going up. That to us indicates more so how long it's going to last than sort of the magnitude of the headline print of inflation. And so, for instance, right, let's just say, one of the reasons economists will back out gas and back out food is the prices are very volatile over time. Generally, you can have those go up while the rest of the categories do not go up. And so they talk about sort of core inflation being the X food and gas. And they'll generally say that, it's transitory when looking at things like that. The issue today is that if you look across the broad swath of categories that CPI tracks, about 70% of them are going up more than 4% year over year. So this is not something that is just a magnitude issue. This is clearly something that has been a breadth issue as well. And that's really what we've seen the impact to the market be so far over the course of the past 6 months. We've derated the amount that we want to pay for earnings, but the earnings expectations so far, both for today and in the future, haven't really changed that much. And so a lot of what we're seeing is just how much are you willing to pay for that dollar coming down? So one of the things that we try to do here at Westwood is we try to think of ways to hedge that risk, right? So let's take, for instance, we already had inflation and then Russia-Ukraine situation came and obviously sort of escalated the inflation situation. And just take two of those categories, right? Like take fertilizer, for instance, right? Fertilizer is something that is being greatly impacted across the globe because of both sanctions and the ability to sort of get fertilizer to where it needs to be to increase crop yields. And so we step back and say, okay, what's the point of fertilizer? Well, you're trying to increase the yield that each individual crop provides for you. All right. If you can't do that, what are some of your alternatives? Well, you can either try to have more seeds germinate, right? That's one way. So that would be some of the tools that you use. Are there companies that make tools? And there are. So can we get more seeds planted that actually start to germinate and turn into what we need? It's one way to sort of offset a yield reduction, a bigger number. Another way is, do you go with just seed companies, right? Are there ways to have seeds that, whether they've been genetically modified or have some ability to be resistant to some of the things that would limit the yield? And so we've looked at ways to kind of invest in those type of companies to offset the fact that we're seeing the price of fertilizer increase, the availability of fertilizer deteriorate. Who would necessarily benefit from that? It's one way to hedge that out. Another way is energy, right? Energy in Europe in particular, given the sanctions. We've gone from a desire to shift towards alternative sources of energy to now we're much more concerned by energy security. And so everybody is looking at, there'd been a lot of coal plants that had been shut down. So who has the ability to get the coal to the coal plants to generate the electricity that a lot of these countries that had started to shift are now going to have to fall back on in order to meet the energy needs of their populace. And so those are just some of the ways that we've tried to navigate the inflationary environment, particularly on the equity side. We've looked at it on the fixed income side as well, but when rates are going up, it generally knocks down fixed income instruments, as you're all fully aware. And so we've generally been trying to hedge with our equity exposure, at least on the multi-asset side.
Thank you. Super helpful. And then Kelly, so geopolitical and commodity risk play an important role in driving investment performance and returns. But when, as part of our risk team, you're looking at various risks, can you help us think through them? And also, how do you work with our different portfolio teams to help address those risks?
Sure. I definitely think about geopolitical and commodity risks and how they impact the portfolios as well. But on my end, I'm watching how these risks might express themselves in terms of performance in the market. So beyond what is the price that we're paying for earnings, what are the broad swaths that are impacting performance? So my focus is really on ensuring that the investment teams have evaluated these risks, that they have an opinion on the potential outcomes of these risks, and to really help them express that when constructing their portfolios. So if we could do that, from there we can watch the daily performance of the strategies, and we can watch the markets, and evaluate whether or not the portfolios are behaving in a way we would expect given the outlook of the teams. If they're not doing that, then we can look at the why of it, the reasons for the dispersion. We can ask ourselves, we can ask the teams to understand what changes need to be made. So the managers are really well aware of what their performance is day to day. So my role really helps them work through their thoughts and what changes they might be considering. I'm here to help them evaluate which assets, which sectors, which investments might be more or less impacted. For example, if we're talking about slowing growth, then we might expect that higher quality companies might perform better than the more speculative companies. So that could be a characteristic that we might want to see how that's being expressed in the portfolios. Or we might look for larger companies over smaller companies. And so we're really helping the portfolio managers think through that construction of their portfolios. So the combination of high interest rates and high inflation, it's really triggered a lot of worries in the US. Is growth going to continue? Will the economy slip into recession? So growth expectations for the markets are a really big concern that we monitor right now. But whatever scenario unfolds, I'm really looking at how the events might impact the future potential performance of our portfolios.
Super helpful. Thank you for your insights. And I think, Ben, just staying on the topic of global growth and slowdown, let's focus on China. We know how important it is to our global growth and also to our supply chains. Can you please recap for us what's going on there?
Sure. Yeah, absolutely. And just, for everybody on the line, the reason we care about growth is obviously because it's going to impact the earnings, especially when we're thinking about the stock market. And so global growth and China in particular are very meaningful in terms of just knowing what's going on and kind of having an opinion of whether it's going to be a tailwind or a headwind. And, given that they have a zero COVID policy, it's been tough to navigate over the course of the past 2 years or so, because they'll go from, opening up to completely shutting down over, a handful of cases. Whereas in the US, we've kind of acknowledged that it's endemic at this point. They are just, they want to stomp it out. And so it's hard to get comfortable in terms of, are they a tailwind or a headwind on sort of a daily basis? because of the start-stop nature that we've seen. And that's caused huge clogs in the supply chain, right? I mean, given that they are a massive manufacturing hub, to the extent that they're shut down and they're not producing, it clearly leads to supply impacts and hurts the supply chain. And then that eventually rolls up to finished products. And so it is something that we clearly need to monitor. It's hurt the economy for now. It's one of the things, given that we've kind of derated on how much you want to pay for a dollar of earnings, and we are now so focused on what that earnings number is going to be, people are much more focused on, okay, are they opening up? Are they not? And the good news is that they've effectively told us that we're going to be, when they open up, they're going to be a tailwind, right? They're going to have fiscal and monetary support. And so it will be a good tailwind going forward once they fully open up and, help to unclog the supply chain, which will slowly start pushing down the inflation rates in some of those categories that we were talking about. And so that's just, we're kind of waiting for that day when we're on that trajectory of reopening. We thought we were there a couple of weeks ago, where you started to see Beijing and Shanghai reopening, and that's taken a step back. And so we're monitoring it just like everybody else, but it will be an important piece once we get that as a full tailwind going forward.
Very interesting. And just to follow up on China and supply chain, I think semiconductors is something that has been on the forefront of supply chain issues. Nobody can buy chips, and therefore we can't buy any electronic products. So that has also caused a lot of rift between Taiwan and China, given that Taiwan is the leading producer of semiconductor chips in the world. We have even heard rumors about China attacking Taiwan to gain access to that. So what are your thoughts there?
Yeah, I mean, it's a very good question. And I would say that's one of our main concerns over time. I think if we need to think about it in terms of probability and possibility for 2022. Is it possible that there's something happens between China and Taiwan? It's absolutely possible. We think probability-wise, it's probably less likely. Taiwan has basically said that they would kind of destroy the semiconductor factories if they were invaded. And so that sort of to China says, well, if that's one of the reasons that we want to reintegrate them, we're probably not going to do that because we lose one of the benefits of having it be fully integrated. I think China also over time would much rather have Taiwan just come back into the fold. They view it as the one China policy. And so I think over time there's a higher probability that something happens to fully integrate it. I just don't think it's necessarily a 2022 event at this point. And so then the question becomes, okay, well, what are the sort of the second order effects of that, right? I mean, if it happens 10 years from now, that gives the rest of the world enough time to kind of adjust to a situation where Taiwan is more fully under China's control. So if we can get the semiconductor capacity and production back to the US, which we're starting to do, if it's all back in the US and we can get everything we need, we've got the specs and the help of Taiwan Semiconductor in terms of doing that, it's less of a concern than if it happens and there are no sort of backup plans. And so that's I think what the world is grappling with right now is over time, it's very likely that Taiwan will be part of China. When it happens is the bigger question of how ready is the rest of the world for when that takes place. And look, the good news is that we'll see asset class at prices percolating. We'll see markets moving well ahead of that. And it's one of the benefits of being part of a multi-asset fund structure is that we are looking across asset classes. So you would see some of the risks bubbling up before you'd necessarily see it in the stock market. And so that, again, that's one of the benefits and sort of risk management techniques that we have on the multi-asset side.
Yes, super helpful. And I think after Russia's attack on Ukraine and the resistance that Ukraine has put up and the sanctions that have been placed against Russia, I'm sure it gives China a moment to take a step back and really think what they are doing before making any aggressive actions.
Yes.
Yeah. So Kelly, focusing about our risk processes, you are looking at market conditions daily. So can you help us to understand how Westwood approaches risk management?
Sure, and I do watch market conditions. I think the first thing to remember is that on our investment side, all of our team members are constantly doing their research, they're monitoring their holdings, their portfolios for that downside risk. That's their major focus because the portfolio managers are the ones that are ultimately responsible for the risk management of their portfolios. In my role, I think about risk a little bit differently. So to me, risk is simply the chance that performance will be different than we expect. So it could be on the downside underperformance, but it could also be on the upside in terms of outperformance. So from my perspective, risk is not good or bad overall. But there is a distinction between the known risks and the unknown risks. And so I'm really trying to help the investment teams evaluate all of their risks so that we can make that unknown portion as small as possible. And this hopefully allows the portfolio managers to implement a portfolio that expresses their opinions about the companies and the markets, and hopefully the portfolios are going to perform in the way that we want them to.
Super helpful. And so, Ben, let's shift our focus to consumers. As you touched earlier, inflation is something that is constantly running hot, and we are seeing here in US that our low-income consumers are having to make really difficult decisions where they are being forced to cut on discretionary spending to pay for basic necessities. So you have a lot of background covering consumer finance. So how do you think the second half of the year will turn out to be? And more importantly, do you expect these issues to creep up to a wider consumer base from low-income consumers?
Yeah, it's a great question. And I think just to start off the answer, we got to think about how the consumer is positioned today in aggregate versus how we've been positioned in the past. And the flip side of having high inflation today is that we've got a consumer where wage growth is very strong, where savings levels in aggregate, again, we will get to the low-income consumer in a minute, but in aggregate, the savings levels are significantly higher than they were pre-pandemic. We have aggregate debt levels for the consumer that are relatively low versus where they were in the past. And we have a lot of credit card borrowing capacity that can be used. And the reason I bring all of that up is because those are really just buffers, right? I mean, that is not a long-term sustainable way to have the consumer live, right? Burn through your savings, rack up credit card debt. It is not a sustainable way, but it is a good buffer. And so I think that's part of the reason that you haven't seen a broader swath of the consumer base feel the same effects of inflation as the lower end consumer has so far. And year to date, that has surprised the market to some extent. Coming into the year in January and even December of last year, when people were thinking about 2022, there was a big discussion of, is the consumer overall going to be pinched from January 1 of 2022? And so far, those buffers have been there to kind of help the consumer bridge the gap between what is hopefully high inflation today that by the end of the year is hopefully significantly lower. But that's the ultimate question, right? How far up the consumer base does it start to whittle into? Really comes down to the question of inflation. And so it goes back to the beginning part of this discussion of why inflation is such an important topic for us and why we're so focused on the broad swath of categories being impacted. Our underlying assumption right now is that inflation is in the process of peaking out, and that by the end of the year it will be lower. Now, is that enough to not whittle into part of the consumer base? Probably not. So I do think you'll see a little bit of, additional consumers besides the low income being impacted. But again, I think we've got a big enough buffer at this point that if we can get inflation under control by the beginning of next year, that probably will bridge the gap in aggregate and soften some of the sort of growth impact that inflation would ultimately have.
Super interesting. And I think I just remembered a question that a client had asked me yesterday, so I'm going to ask you as well.
Sure.
Is when COVID happened, we got a lot of stimulus from government, people's average savings went up, and then the stimulus check stopped, I think it was last October. Now that the consumer is kind of getting crunched again or crushed again, are you thinking, is there any likelihood of more stimulus checks by the government?
That I actually think will come down to the growth, right? I mean, if growth really slows, I think the lesson that Congress has learned is that we can lessen the blow to our underlying constituents by giving them money. So I think that probably will be one of the reaction functions to growth really slowing. Now, if growth doesn't really slow because the buffers are there, I think there'll be less of sort of a giveaway of money. There might be some of these gimmicks of like reducing the gas tax for 3 months to try to help bridge the gap. But I don't think we'll see the same types of stimulus that we saw unless growth significantly slows. And then it's just, generally people remember the last thing that happened, and the last thing they did during the pandemic was give away money.
Okay, that is super helpful. And I think the way the likelihood that we will have a split government after midterm elections, we'll probably not see a lot of sweeping actions by the government for the next couple of years, which traditionally has actually been a positive outcome for the markets. Okay, so Kelly, coming back to you, one thing that we have seen, especially given all of the things that are happening across the globe regarding geopolitical events, global warming, and things like that, we are seeing a lot of capital inflows into ESG policies as well. So, can you help us understand how we at Westwood look at ESG principles and incorporate it in our investment analysis?
Sure. Westwood has always been a manager that focuses on really good fundamental research. So we take a fundamental approach to identifying high quality businesses. ESG related issues are also critical in conducting that kind of research. And longer term, that contribute to determining a company's strategy. What is the risks and the opportunities to a company? What is their valuation? So across all of our different strategies, we've really designed our analysis to focus only on material factors. So those ESG factors that impact the upside or the downside. And by doing that, we think that including these material ESG issues really improves our fundamental analysis, and it enhances our investment decision making. So we're doing what's called a materiality-based evaluation of ESG characteristics. So it's really all integrated into our holistic assessment of a company. So again, we're looking at the quality of a company, we're looking at the downside risk, we're looking at the potential future performance. But at the end of the day, if it's important to the risks and the opportunities in a security, it's going to be part of our investment research.
Thank you so much, Kelly. Ben, these are all the questions I had. So thank you so much, both of you, for your insights. And thank you, everyone, for taking your time out to join us today. We hope you have a wonderful rest of the day. And please feel free to reach out to your advisor if you have any questions. Thank you. Bye.
Thank you.
Thank you.